In this example video, we're going to look at exercise 960. That's going to put together a cash payment schedule. So not just looking at when we're going to have to pay for purchases on account, but also looking at when we are paying for our direct labor, what's included in our overhead, if we had to repay a loan, all of those different components. So they tell us that our company purchases their direct materials on account, so that would be coming right from our direct materials purchases budget. And they give us how much we're planning to purchase for the months of June, July, and August. They tell us that on average they pay 20% of their accounts payable in the month of the purchase and the remaining 80% in the following month. They give us the direct labor cost for both July and August, and that the company typically pays 90% of the direct labor cost in the current month and the remainder in the following month. They tell us that our overhead in total amounted to $71,200. It includes $6,350 of depreciation, and the company had to take out a 4-month loan in total of $15,000 on May 1st. The interest due at the payment of principal that accrued at a rate of 9% per year, and the loan and all interest is going to be paid on August 31st. So they want us to prepare a cash schedule. So we got a 2-month payment process for our on-account purchases. So if we're looking at our on-account, June, 20% of that $68,000 would have been paid in June, which means 80% would have paid in July, nothing left to be paid in August. In July, we buy $77,000 on account in direct material purchases. We plan to pay 20% of that $77,000 in the month of July, which means that we plan to pay the remaining 80% 1 month later, which would be August. So $77,000 in on-account purchases times that 80%. We plan to have to spend $61,600 for those purchases in July. For August, we plan to buy $73,000 on account for direct materials, and we pay 20% of that balance in that month. So we'd have to pay $14,600 in total. For direct labor, we don't pay our direct labor employees the same amount each month, so we have to break this component out. So they said in July, $32,300 they had in direct labor cost. They would have paid 90% of that $32,300 in the month of July, which means they have to pay the remaining 10% 1 month later, which would be August. For August, they told us in total our direct labor cost was $35,400, and we pay 90% of that in the month that our employees have worked for us. Our overhead, this is really important. Our overhead said in total that it was $71,200, but that it includes $6,350 in depreciation. Remember what we're looking to do here. First word here, it's a cash payment schedule. We're looking at how much cash we have to spend out to meet our company's needs. Depreciation, if you think about the adjusting journal entry for depreciation, we debit depreciation expense, but we don't credit cash. We credit accumulated depreciation. It's not an expense that we spend money out for. It's simply a way of reducing the value of an asset that we're utilizing in our business. So because of that, we need to factor that out of our overhead amount. So $71,200 in total minus the $6,350 in depreciation. So really, our total overhead is only $64,850. And then they have to repay a loan. So they said the principal amount, the total amount of the loan was $15,000, but they also have to pay interest. And remember, your interest rates are always expressed in annual terms. So it was a 9% annual rate, but I only had 4 months to pay back that loan. So I'm certainly not going to repay a year's worth of interest if I didn't have a year to pay it back. So when you're doing your interest calculation, it's the $15,000 principal times the annual rate times the amount of time you've had it. So only 4 months out of 12. So in total, we have to repay $15,450. So in total, we have total cash payments of $191,590 for the month of August.